How much home can you purchase with, say, $50,000 or even $75,000 of income using conventional financing? Conventional financing requires a minimal down payment of just 3% and goes as low as a 620 credit score. I recently did a similar video using FHA financing, and a lot of you commented asking for this video, so here we are. Now, the biggest difference between conventional and, say, FHA financing, outside of the down payment being a 0.5% difference with regards to the minimum, is the underwriting guidelines, how strict the underwriters are when they underwrite these files. Conventional guidelines, unfortunately, aren't going to be quite as lenient as, say, FHA guidelines. You can't go quite as high on the debt to income ratio. You can't go quite as low on the credit scores, which makes conventional financing a little bit harder to get approved for. But in many cases, if you have higher credit scores, you have a little bit more of a down payment, conventional financing is going to end up being the better option for you. But in today's video, we're going to do some back of the napkin calculations, if you will, with regards to putting 3% down, putting 5% down, putting 10% down using conventional financing, and then we're going to see how much home you can actually afford if you make just $50,000 of income or if you make $75,000 of income. Now, one thing to keep in mind when we do these calculations, it's really for novelty purposes. Yes, I'm going to show you how to do them so that you can do them at home, but don't use these numbers to think that you're pre-approved because you qualify based on the numbers that you're running yourself. Make sure you're taking the time, working with a mortgage professional, having that conversation, because the chances are very, very rare that your scenario is going to match exactly what we talk about in today's video. And at the end of the day, you don't want to end up thinking that you're qualified when in fact you're not. So make sure you're having that conversation with a mortgage pro to verify the numbers and confirm that you're actually approved before you go out shopping for homes. Now, if you need a mortgage referral, if you need a professional to talk to, I've taken the time to put a link in the description below of people I know, like, and trust that can guide you through that process. Now, before we dive into that, I want to take a minute and ask a favor. Do me a favor and smash that like button if you find any value in these videos at all, and feel free to subscribe to the channel to stay updated on mortgage, interest rates, and everything real estate related. I want to start today's video by doing some income calculations. Now, lenders, when they approve you, they're going to use your gross monthly income. And I know oftentimes when we talk about gross monthly income, people watching the videos are saying, well, that's before my taxes, that's before anything. Why are you using that number? Why aren't you using what I take home, my take home pay? And the primary reason is because people's take-home pay varies based on the number of exemptions they have, based on whether they contribute to a 401k, based on whether they contribute to some sort of deferred compensation. So people's take-home pay is going to vary based on other factors. So a lender, when they're actually calculating your income, they're using your gross monthly income. That's before any taxes are taken out. So in today's video, we're going to use the same calculation. Now, the thing to keep in mind for this video is we're just basically doing a basic wage earner position, making $50,000 and making $75,000 a year for an easy calculation. If you're a self-employed borrower, you have write-offs, you have all of this different stuff, you have Schedule C income, you have investment properties. It's that much more important to make sure you're having a lender verify these numbers and calculate your actual income that could be used for qualification purposes. Otherwise, you could get a lot of things misconstrued and end up calculating with the wrong numbers. But for today's video, we're just going to do a basic calculation. We're going to say that you make $50,000 of income. Lender's going to take that and divide it by 12. That number comes out to $4,166 per month. Now, with that said, a lender has a debt to income ratio maximum that they will allow. Now, you're probably watching this going, what does that mean? Well, they will only allow you to use a certain percentage of your monthly income towards debt. So in the case of a conventional loan, guidelines read that they'll go somewhere around a 43%, but more often than not, you can get a conventional loan approved with a 45% debt to income ratio. I've seen them approved as high as a 49% debt to income ratio, but for purposes of today's video, we're going to use 45%. Now, something to keep in mind when I'm talking about these income calculations and, getting approved at higher amounts and what have you, a lot of it has to do with compensating factors. The higher your credit score, the more money you're putting down, the more likely you are to get approved with a higher debt to income ratio than, say, someone with low credit score. So just keep that in mind. And what's going to happen is when you get approved for a loan, the lender is going to take all these calculations, run it through an automated underwriting system. And if the system approves it, then you're good to go. But the thing to keep in mind is that system is only as good as the information that was put into it to start. And that's another reason that you need to make sure you're working with a professional versus somebody that just got their license. So when we take that $50,000 annual income and we break it down monthly, that's $4,166. The lender is going to allow you to use, say, 45% of that based on our conversation in today's video, which equates to $1,874, which means that you can't have more monthly debt than $1,874. That's including your mortgage payment, that's including your property taxes, that's including your mortgage insurance, your homeowner's insurance, and any other debts that you have, say a car payment or credit cards or even student loans. And with that said, we're actually going to run the numbers with a little bit of debt and without some debt, just to give you an idea of both calculations, because most people out there aren't walking around with no debt. Some people are going to have at least a little bit, but at the same time, there's going to be some people out there that have no debt other than what their housing payment is going to be. So we're going to give you calculations on both so that you can see exactly how much home you can afford. So for purposes of running our first scenario, we're going to assume that you have around $450 in monthly debt. We're going to assume that you have a $300 car payment. We're going to assume that you have about $50 of monthly payments in credit cards, and also that you have around $100 in student loans that you pay every single month. And for the student loans, we're just going to assume that's an IBR payment. So total monthly debt in this case is going to run $450. And once we take that debt to income ratio of 45% that we had earlier of $1,874, and we subtract that $450 in debt, that means we can't have a mortgage payment more than $1,424 per month. And again, as I mentioned earlier, that's going to include the mortgage payment, the property taxes, the mortgage insurance, the insurance. Everything combined can't exceed that $1,424. But let's take a minute here and look at couple different scenarios, putting 3% down, say putting 5% down, putting 10% down. How much home can you actually afford, with that $1,424, assuming a little bit of debt, and how much can you afford with no monthly debt? Now, for today's video, we're going to assume that you have great credit, that your credit score is higher than 760. And we're also going to assume that there's two borrowers on the loan. And I'll talk about why we're assuming two borrowers on the loan here in just a minute. But let's start with, say, 3% down. So if you're buying a $250,000 home and you're putting 3% down, that is $7,500. That's the down payment required to buy that home, which means that you'd be financing $242,500. And today's interest rates on a 30-year fixed with 760 credit scores, 3% down, is around 6.25%, which is going to give us a mortgage payment of $1,493 per month. Now, on top of that, we're going to have property taxes. The national average for property taxes is 1.1%. Now, some areas of the country are 2%, 2.5%. Some areas are a little bit less, but the national average is 1.1%, so that's what we're going to be using in today's video, which means the property taxes would be $229 per month. Now, because you're putting less than 20% down, you're going to have mortgage insurance on this loan. Anytime you put less than 20% down, there's mortgage insurance involved. Now, the biggest difference in conventional and FHA is with FHA, mortgage insurance stays on it for the life of the loan, unless you put at least 10% down, in which case it falls off after the 11th year. Conventional loans, once you have 20% equity in that property, you can go to your lender and have that mortgage insurance removed. But in today's video, we're going to use the mortgage insurance calculation because, again, you're only putting 3% down. And a moment ago, I mentioned having two borrowers on the loan. The reason for that is when you have more borrowers and you have higher credit scores, the mortgage insurance is actually going to be less. And most people these days are buying homes with multiple people just because of housing affordability, because house prices have gone up so much. People are banding together. You have spouses, you have partners working together to purchase homes. So in this case, we're saying there's two people and we're saying they both have credit scores above 760, which means that you get a really, really good rate on the mortgage insurance, which is going to be 0.0034%, which in this case means your mortgage insurance is going to be $68.71 per month. On top of that, you're going to have homeowner's insurance. That homeowner's insurance on a $250,000 home is roughly going to run you around $52 per month. Now, insurance is another one of those things that can vary tremendously depending on the area that you're located. If you're in an area that's prone to floods, prone to hurricanes, prone to, natural disasters, if you will, insurance is probably going to be quite a bit more than the number we're using here, but we're using a calculation of 0.0025%, which in this case gives us a total mortgage payment of $1,843 per month. Now, if you remember our initial calculations of the $50,000 of income at a 45% debt to income ratio, we couldn't exceed $1,874, which means if you had no monthly debt, then you could potentially qualify for this $250,000 home, putting just 3% down. But if you had the debts that we mentioned, unfortunately, you're not going to be able to qualify for this home because your debt is going to exceed that debt to income ratio that conventional financing allows. Now, if we run the same exact scenario, putting 5% down, so you're putting a little bit more money down, 2% in this case, which ends up being $5,000 more with regards to your down payment. All of the calculations are more or less the same, but the interest rate is slightly less at 6 1/8%, so 6.125%, and the mortgage insurance is actually going to be a little bit less at 0.0026%, which in this case, your mortgage payment is $1,443 per month. Your taxes end up at $229 per month. Mortgage insurance at $51.46 per month. And your homeowner's insurance, once again, is sitting around $52 per month. So your mortgage payment would end up being $1,775 per month, putting just 5% down, which again means that you could qualify with that $50,000 of income, but you'd have to have very little to no debt at all. If you had the $450 of debt that we mentioned earlier in this video, then unfortunately you wouldn't be able to qualify for that $250,000 home, which is 5% down. And the scenario works out more or less the same for a 10% down payment, believe it or not. In this case, you're putting $17,500 more down. The interest rate stays the same at 6 1/8%. The mortgage insurance improves a little bit at 0.0021%, giving you a total mortgage payment of $1,687. So you still wouldn't be able to qualify with the $450 debt that we mentioned earlier, but if you had little to no debt, you'd still be able to make that $250,000 home work. Now, could you make a $300,000 home work with 10% down? Unfortunately not. Running those same exact numbers, your mortgage payment would be sitting just over $2,000, which means at $50,000 of income, you would not qualify. Now, how about if we run the exact same numbers with $75,000 of income? So if we're using the gross monthly income, that is $6,250 per month. Now, again, conventional financing, we're using a 45% debt to income ratio, which is $2,812. That's with no monthly debt. The max your mortgage payment in this case could be is $2,812. Now, if we were using those same debts from earlier, $450, $300 for a car payment, $50 for credit cards, $100 in student loans, totals $450. The max you would be able to spend on your mortgage payment is $2,362, which means with 3% down, you'd just be able to qualify for a $300,000 home. As that $300,000 home, putting 3% down, that's $9,000, which means you're financing $291,000. We're going back to that same interest rate of 6 1/4%, which gives you a mortgage payment of $1,791. Again, we're using those property taxes at 1.1%, which means your property taxes are $275. The mortgage insurance on this one at 0.0034% is going to be $82.45. On top of that, your homeowner's insurance is going to run you roughly $62 per month, giving you a total mortgage payment of $2,211. So with $75,000 of income, $450 of monthly debt, and only 3% down, you'd be able to qualify for a $300,000 home. But what about if you had no monthly debt? In that case, you would qualify for a home somewhere between $350,000 and $400,000, as the numbers on a $350,000 home, using the same calculations that we just used, would be $2,580, which is less than the 45% debt to income ratio, which means that you should qualify. But the $400,000 home, that total mortgage payment is $2,948, which exceeds that 45% debt to income ratio, meaning that you probably couldn't go quite that high with just $75,000 of income, even if you had no monthly debt. Now, here's the thing. As I mentioned earlier in the video, we're using 45%. I've seen conventional financing go up to 49%. So in the case they go up to 49%, then you might be able to make that $400,000 home work. Now, in order to keep this video short, I'm going to cut the numbers here just a little bit, but putting 10% down using the same calculations that we've used throughout this video, the mortgage payment on that $350,000 home, putting 10% down, is $2,362, which is exactly the max number that you can use to qualify with that $450 of monthly debt. So if you're making $75,000 of income, you have around $450 in monthly debt, you should be able to qualify upwards of a $350,000 home, putting 10% down. And at the same time, if you have no monthly debt, you should be able to get over a $400,000 home, as the payment on that is $2,700 using the same calculations that we used. And we know that you could go as high as $2,812 based on that max debt to income ratio of 45%. Now, I know videos like this can get super confusing because I'm throwing a lot of numbers at you at once, but what I'll do is I'll take these numbers, I'll put them in the description below so you can try to use them yourself, do some calculations, understand the numbers that I'm going over to help it make more sense. Now, I know I'm going to have some people out there watching the video going, well, what if I have lower credit scores? What if I have a 640 credit score? How does that actually impact things? Well, with a 640 credit score, you're going to qualify for considerably less house. Why? Because the interest rate is going to be higher, which means that your monthly payment is going to be higher. And on top of that, your mortgage insurance premium is going to be considerably higher. So between your mortgage insurance premium and your mortgage payment going up, that's really going to push the limits on that debt to income ratio, making it very, very difficult for you to qualify in this scenario. But I'm going to show you the difference here in just a minute in those two scores. But what I would say is that if you do have lower credit scores and you're trying to buy a home, especially putting 3-5% down, take the time and work on your credit. It has a huge impact on your monthly payment, which in turn affects how much home you can end up purchasing, right? The max that you can qualify for. So by working on that credit score, it's going to give you a better interest rate and in turn, a lower monthly payment and a higher pre-approval amount. But the biggest difference when it comes to lower credit scores is how much it impacts the mortgage insurance. In the case of this video, if you were putting just 3% down and had a 640 credit score versus a 760 credit score that we used earlier, your mortgage insurance would be about $216 more. And at 5% down, it'd be about $148 more. And even with 10% down, you're looking at nearly $94 more per month with regards to mortgage insurance because of that difference in the credit score. In addition to that, it's also going to impact the interest rate. In the case of putting 3% down, you're looking at a rate about 0.3% higher, coming in somewhere around 6.5 to 6.625%, which means your mortgage payment would be impacted by about $40 per month. And that's not including the mortgage insurance difference either, but the total between the mortgage insurance and the mortgage payments around $255 per month. So that's a sizable difference between that 640 and that 760. So take the time to work on your credit scores. At 5% down, the interest rate is also around 6.5% with that 640 credit score, which is about $58 difference per month. And with 10% down, the difference is about $55 per month. And with the mortgage insurance, we're talking $206 differential and $148 differential. So big difference in having good credit scores versus having bad credit scores. Now, if you're new to the process, don't understand these numbers, not real sure where to start, I created a first-time homebuyer course that goes over the process of buying a house from A to Z, everything that you need to know to set yourself up for success. So if you're interested in becoming an expert, becoming the educated homebuyer, do me a favor and check the link below. Lastly, I want to stress how important it is to make sure you're working with a mortgage professional, having somebody calculate these numbers, look at your income, look at your credit scores, and come back and give you numbers. Not just having a conversation over the phone, not a pre-qual. You need a full pre-approval. Someone to look at all of this documentation, analyze it, and come back with numbers. Don't try to do this on your own because you could be setting yourself up for failure. But if you're watching this and you like conventional financing, you like the numbers that you saw, you think conventional financing is the direction you want to go, do me a favor and check out this video here. I'll go over all the qualifications that you need to buy conventional financing, and it's a great place to start.